Intel Corporation finally fired its CEO. Is Intel now a buy, as the company is probably going to be broken up in the next several months or even years ahead? We had earnings from Marvell. We'll take a look at Marvell. Interestingly enough, Marvell's got almost the identical valuation as Intel. We'll see if it's even worth that much. And we'll talk about Broadcom, which reports earnings this Thursday. We'll go over some of the things that you need to look for. But we start with the big news of the week, and that is Intel Corporation. Over the past 5 days, shares of Intel down 15%, a real negative reaction after the company announced that CEO Pat Gelsinger is on the way out. Now, when they announced it, they said he was, quote, retiring. But I think everybody that has been following Intel probably knew exactly what happened here, is that he wasn't retiring. In fact, he was fired. He was replaced by 2 co-CEOs. Internal hires moved up. This typically what I see in this scenario, because later on rumors came out that he was basically forced out by the board of directors as they lost confidence in his turnaround plan. We'll talk about some of the efforts that Pat has gone through over the past couple of years with Intel, and how we have identified on the financial sheet that the turnaround plan was just not working. So I view this as a very positive sign for Intel. The board of directors got it right here. Now, there's people inside of the semiconductor industry that's going to go to bat for Pat and say he never got a fair shake or Intel didn't give him enough time. Guys, this is Wall Street. You have to put up results on the financials, and when I show you these financials, they're just simply not good enough. So I think this company is on a path to be broken up. Part of it has to do with the fact that's probably the best outcome for Intel and its shareholders, and the business model has just gotten overly complicated, and the foundry and design business just simply is antiquated in the semiconductor business. So I think this company is going to get broken up. You also have the incoming Trump administration, which could have I will say just slightly less hands-off approach as it comes to mergers and acquisitions and companies purchasing pieces of other companies. And so Intel might see this as a window over the next 4 years, as this is when you piece out Intel. First of all, semiconductors are red hot. We'll go through several other companies here with record valuation, record high stock prices. So Intel should be red hot. Instead, shares of Intel are basically trading close to 52-week lows. So this company is drastically underperforming. Now, when we look at the financials, there's a big reason why the CEO is on the way out. From an operating perspective, the company is basically at a big time loss. Now, when you factor in some restructuring and some cost cutting, you could add that back in. You also had some cost of sales restructuring impacts there as well. But overall, the company is basically not making money when other companies, particularly Nvidia, even AMD, are essentially printing money at the current time. The company also has made a big mistake in trying to go back to an antiquated model in semiconductors, where you not only design the semiconductors, but you also try to manufacture them. All semiconductor companies outside of Intel have basically tried to separate the two business models. At least when we're talking about high-end leading-edge chips, you typically use Taiwan Semiconductor because they have proven time and time again, and we'll have a story when we get to Nvidia, that they can scale up their factories and their manufacturing chops much faster than anybody else has really ever done in the history of semiconductor manufacturing. And Intel's foundry business year over year actually had declining revenues from $4.7 billion down to about $4.4 billion. Even worse than that is look at the foundry business losses from $1.4 billion last year down to an acceleration of the losses to $5.8 billion. In fact, the losses exceed the revenues over at the foundry business. Pat Gelsinger, maybe he can design chips. Maybe he can run the computer chip business or the data center project or some other aspects of Intel's business, but he had proven time and time again that he could not run the foundry business. So what's going to happen with Intel is, I believe other companies inside of the semiconductor business are going to buy up pieces of this company. The foundry business, you might not find a customer for that, but that probably potentially could be spun out into its own separate company. Intel might maintain some type of control over that or some type of interest in that company. But it would be better if you separated this money-losing business outside of this. Qualcomm has knocked on the door numerous times for Altera and other pieces of business at Intel. And I think what Pat was doing, he was holding up those negotiations. Pat was probably getting in the way of the Altera negotiations. Qualcomm coming in and bidding for the computer chip business because Pat wanted control of the whole thing. He had this idea that he was going to turn Intel into this behemoth. And it was flawed logic. And finally, the board of directors recognized it and got him out. And this company is going to be broken up because, again, we've got a $90 billion valuation. We'll talk about Marvell here in a second, which is not a profitable company and a company that is doing just $1.5 billion of revenue in a quarter. They've got the same market cap as Intel. So it's a shame this company has not benefited from the rise of the semiconductor industry over the past couple of years. And Pat being out is an absolute good thing. Now, a company that has its stuff together is Nvidia. Over the past 5 days, shares of Nvidia up about 1.8%. Not a ton of news out of Nvidia this week, but Taiwan Semiconductor and Nvidia showing off that Taiwan Semiconductor, no news here, is the best in the business when it comes to manufacturing chips because they've just more recently spun up a factory here in the United States. In fact, this thing was just a plot of land just a couple of years ago, and now they're planning to make the most leading bleeding edge chip inside of that Arizona facility. We've already seen news that Apple is already producing leading edge phone chips inside of the factory at volume production. In fact, TSM has said they weren't going to get to volume production until 2025. So they're still just ramping things up. And it looks like maybe sometime next year, you'll get Blackwell AI chips coming out of that plant here in Arizona. Now, that doesn't mean that these Blackwell AI chips won't get shipped to Taiwan or won't get shipped to even China or other parts of the world to be put inside of data centers and then maybe reshipped back here to the United States. But the fact that they've spun up this Arizona facility so quickly, and it looks like things have gone so smoothly, makes Intel's inability to take billions and billions of dollars, not only from shareholders, but more importantly, the American taxpayer and the United States government, and basically have nothing to show for it, makes Taiwan Semiconductor just the absolute winner in the manufacturing space. Now, another winner we identified on our newsletter. I know most of you are already subscribed to the newsletter, but if you're not subscribed to the newsletter, you need to get subscribed to the newsletter because we sent out a recommendation last week, and the very next day, the shares went up about 18%. So you could have bagged an 18% gain on a company that Nvidia invested in. In fact, we think there is much, much larger gains ahead for this company. Make sure you subscribe to the newsletter because currently right now it is free. Very soon, it will be switching to different tiers of pricing. There'll always be free content here on Equity Empire and the Investor Channel, and even on the newsletter. There's always going to be free. Some of you might not be able to afford to pay anything for investing content, and that's totally fine. There'll be a very low-cost tier, an entry-level tier, and then it'll move up from there for different types of access and recommendations. Certainly on the small cap side, we are going to be charging a decent amount for the small cap because our recommendations can move the smaller stocks. We actually want to limit the number of subscribers to our small cap service so you guys can get in before the stock has kind of a massive reaction after a lot of subscribers take advantage of the recommendation. Make sure you are subscribed because I'm going to give existing subscribers a deal that will expire after a certain period of time. And so make sure you're subscribed to the free newsletter so you get the deal when the paid service rolls out. Now, Advanced Micro Devices saw its shares fall by about 1% this week. Unfortunately, Amazon executives kind of threw some shade over on AMD that they are saying that they're not seeing a lot of heavy demand for their AI chips to the tune that AWS is not really even offering AMD chips or the ability to spin up an AMD AI server on AWS because there's simply not enough demand here. I don't think this is necessarily a huge surprise what we are seeing from AMD from the demand side. And I don't have AMD's financials up here, but their data center revenue was just fine. In fact, on the conference call and in the guidance, they were very confident that demand was going to be there in the upcoming quarters ahead and even the year ahead for that data center chips. You're seeing it from the sovereign governments. You're seeing federal governments. You're seeing Lawrence Livermore Lab, which is out here in California, spin up a large AMD server. You're seeing Microsoft, even Meta, companies that are running at full capacity, not getting full capacity from Nvidia, and that don't have custom silicon options like Google and unlike Amazon, use AMD products. Now, I think where AMD benefits the most in the coming year or two is actually Intel, our initial story. The fact that Intel is absolutely collapsing on itself, the longer that happens and the longer the company kind of languishes and doesn't have true leadership, that will help AMD, because still their bread and butter from kind of a core business standpoint is PC, laptops, notebooks, and data center from a traditional CPU x86 process. So the more trouble Intel is in, it's probably better for AMD. Now, speaking of trouble, we've got Super Microcomputer. You can tell we're in a hot market. Crypto's at 100,000. There's these stocks that like meme coins, like Fart Coin, have multi-$100 million valuation. That is because Super Microcomputer, people are just throwing out the fact this company has not reported a set of audited financials, I think in about 6 months. And we'll talk about today, you're still not expected financials for another couple of months on this company, but who cares? Shares are up 18% on Super Microcomputer, back up to $44 per share. We'll show this to you technically. It's actually looking somewhat decent, but we could be at a turning point. We'll see here. Now, the company jumped this week on an internal review. So the company reviewed itself and found, shockingly, no misconduct, but here, there's a tad titch of irony in this. They found no misconduct over at Supermicro, but folks, they decided to fire the chief financial officer. They fired the chief compliance officer and the general counsel, which basically was telling what these people could do legally. And they named the previous vice president of finance the new chief accounting officer. So this company has not filed a set of audited financials in months. We're not expecting those till the end of February. That includes a 10K annual report. That includes the last quarterly report, but it also probably will include the next report, which I think is due towards the end of January or into February. So the company found that they did nothing wrong, but it basically fired everybody in the executive suite that had to do with finance, accounting, and fraud. Now, on the positive side, the company did receive an extension from NASDAQ. We were always expecting this. If you follow penny stocks or you invest in penny stocks, you know that the NASDAQ and most of these marketplaces, they're very lenient up to a certain point to give companies several extensions when it comes to coming into compliance. The company now has until February 25th. This has been pushed back multiple times. It was the end of December. Then I think the end of January. Now we're towards the end of February to file that 10K annual report and also the quarterly report that was ended September 30th. But I think this overlaps another earnings. So the company is going to actually go 3 separate earnings reports without filing a set of audited financials. Again, if you want to invest in these types of stocks, in the type of market that we're in, these things go up. If we were in the doldrums of a market, this would be a penny stock at this point. This type of news is just not good. And I'll say it again and again here on Equity Empire, not as it just relates to Supermicro, but it relates to stock picking in general. Your stock picking should eliminate lots of stocks that go up and down in price. Look at Warren Buffett. He said he wouldn't buy all of Bitcoin, I think, for $25. He said that a couple of years ago, and people were making fun of him. Warren Buffett has more money than everybody that's going to watch this video and any video that I ever make the rest of my life combined. I have passed on dozens and dozens and dozens of stocks that go up in value. Do not turn back and look, oh, look at that stock going up. That is what is called FOMO investing, fear of missing out. Create a process to invest in stocks. If a company falls outside of that process and that blueprint, you completely ignore it. If it goes to the moon and it skyrockets in valuation, maybe like crypto, maybe like Supermicro, maybe like Palantir, maybe like PayPal or any of these other stocks, that is completely fine. Stay disciplined, find a formula that works, and continue to repeat it. Now, let's move over to Marvell. Will Marvell's results be good enough for me as an investor to be interested in it? I think what jumps off the page, first of all, of the past 5 days, shares of Marvell up 18%. I think what also jumps off the page, you got a $98 billion valuation on this one. I pointed out that Intel which has exceedingly higher revenues than this company, has a $90 billion valuation. So it just goes to show you how far and fast Intel has fallen. So Marvell's got a lot to live up to, because we got a $90 billion valuation on this one, and the company just reported their Q3 earnings, and they came in at $1.5 billion of revenue. Even Intel's financials, which are a complete mess, have double digits on the revenue side. So you got a minuscule amount of revenue and minuscule growth on this one. I think if we were in not a hot market, this stock would be worth significantly less. You grew at just 7% over the past year on this one. You've got a 72 times forward multiple on this one. In fact, the multiple and the valuation exceeds Intel, which has a much larger and wider business. But Wall Street doesn't care, because they gave an outlook of a $1.8 billion for the next quarter. Wall Street maybe was a little behind the times on this one. They were expecting just $1.65 billion. Going forward with this company, you are expected rapid growth, 25% growth in the upcoming quarter to that aforementioned $1.8 billion. You look forward into next year, you should have really strong growth, 50-60%. But again, it's still just 1.8, 1.9. We should exceed $2 billion in revenue at Marvell towards the tail half of next year. And again, we've got a company with a $90 billion valuation. More worrying to me as an investor is the company is not profitable. Now, some of it has to do with the fact that they have some restructuring charges over the past year. I think that's also hitting probably a little bit of their cost of goods sold, because their gross margins just shriveled up over at this company. But even factoring that in, giving them all this $358 million in restructuring charge, taking it away from these operating expenses, you still have an operating loss over at this company. And so when a sector like semiconductors is so red hot, if you're buying into Marvell's story, you have to assume that semiconductors are going to stay red hot, probably not just into next year, into 2025, but this is going to be a 2026 and probably a 2027 story as well. Now, in some ways, I do believe that, but we'll talk about a company here in a moment that basically directly competes with Marvell, and that is Broadcom. We'll look at their financials. It far out exceeds this company. So if you have any hiccup in the semiconductor industry, the Marvells are going to get kicked to the curb faster than Intel was this week. Look at your operating loss from $100 million down or up to $700 million. This is not profit. This is a loss. You pull down to a net income number. You're losing money over at this company. And again, we're in a red hot market. So it makes you believe that, hey, if things were to cool off just a little bit for this company, or if competition were to really knock down the door, knock down pricing, probably wouldn't be good for this company. It saw cash leave the building on the balance sheet side. Nothing to be overly concerned about. They don't have a ton of long-term debt, just $4 billion. Cash flows paints a different story with this company, because we add back in restructuring, add back in amortization, which is just kind of an accounting charge, and you get a little bit back on stock-based compensation. So over the past year on a quarterly basis, you went from $503 million of operating cash flow up to about $536 million. Now, the good news is they're not Intel. They're not trying to spend tens of billions of dollars building out factories. And so they only had $75 million of this $536 million that was spent on property, plant, and equipment. So they bought back the stock, which is actually a true buyback, because you have stock-based compensation of $158 and they bought back $200 million. It's not usually the case for this company. Stock-based compensation exceeds the buyback, but you actually had a true retiring of shares. They pay some dividends and they do some other stuff. So there's some shareholder friendly stuff. But for me with this company is, first of all, they don't have a massive competitive moat around their business. Talk about Broadcom. There's others in this industry that compete directly with them that have much better financials. I think we've gotten into one of these markets where these companies are hot. You have retail investors piling into this stuff. You have funds. You have people that are just trying to chase gains. And so Marvell is benefiting from this. You're trading at a 52-week high. I would wait for pullbacks on this one. It's not exciting really at all. Company that is relatively exciting, even though we are trading at 52-week highs, is Broadcom. But we have earnings this week. I think they are on Thursday. We'll confirm that when we get to the technical segment. But shares of Broadcom, I think, kind of rode the Marvell news, because if Marvell's going, you know Broadcom's probably going too. They were up about 8.8% this week to finish the week close to about $180 per share. The company reports earnings this week. We're expecting about $14 billion worth of revenue. It just really makes Marvell look incredibly small Also, obviously, this company has a massive valuation, $838 billion, but you're only trading, I say only, 37 times on this one. You are going, and it's a little sneaky on paper, you're going to see growth of about 51%, but this is not all core organic growth. I'll show that to you here in a second. This is some VMware acquisition over the last year. As you move into next year, this is comparable year over year, you are still growing high teens, maybe as high as 20%. Now, Hock Tan, the CEO of Broadcom, is a Wall Street guy, has a Wall Street background, so he knows how the game is played. He very, very much tries to sandbag or give conservative guidance, and then he tries to come over and above that when the company reports. So here's the things, one of the things to watch for when we look for Broadcom earnings later this week is, first of all, they better come close to this $14 billion. In fact, they need to come over it for the stock, although again, this is like a crazy market where everything is going up. But in my opinion, the company needs to come over this $14 billion, probably closer to the high-end estimate at 14.6 for the shares to react positively. On top of that, they need to give Q1 guidance that exceeds $14.5, $14.6 billion. In fact, you'd like to see a number close to 15, but I won't hold my breath on that one. That would give Wall Street guidance and confidence that the company is firing on all cylinders. Now, what you're getting with Broadcom is actually a little bit different than most semiconductor companies. They do have a diversified business. They have infrastructure software bolstered by multiple acquisitions over the past couple of years, more recently VMware. Infrastructure software accounts for $5.8 billion of the $13 billion that they put up last quarter. Semiconductors at about $7.3 billion. You notice the growth rate, just 5% growth on the semiconductors. So it's not an explosive growth business, but the margins have expanded over the past year. Now, infrastructure software has grown 200% over the past year. Again, almost all due to the fact that they acquired VMware. You'll see that when we get over to the financials, which are absolutely stellar for this company. Off of $13 billion last quarter, you printed about $3.8 billion to the operating side of the business. Now, the company did have to borrow a lot of money to acquire VMware. It was a tens of billions of dollars transaction. I think 50 or 60 billion off the top of my head. It was a massive acquisition. And so look at your interest expense just on a quarterly basis, over $1 billion. So as interest rates go down, it not only lowers this company's potential interest rate expense, but it also opens the door for this company to continue to do more acquisitions. From a balance sheet perspective, you will see that this company is sitting on a relatively significant amount of debt. Your long-term debt is sitting right here. Last year, again, $37 billion, ballooned to 66, again, because of that acquisition, and it's not balanced off. This is not Google. This is not Microsoft. This is not Apple. It's not balanced off with cash. In fact, you have just 19 or close to $20 billion of total current assets, and a lot of this company's assets actually sit in the goodwill line because, then again, they've grown their business through acquisition. So Broadcom benefits from a deregulating environment where companies can go out and make acquisitions, also a lower interest rate environment. So you can see why, a couple of reasons why this stock is trading at a 52-week high. You're moving into an environment where maybe you get a little less regulation from the mergers and acquisition side. You're also getting slightly lower interest rates probably over the next couple of years. So that benefits this company. From a cash flow perspective, the company is doing just fine. $5 billion of operating cash flow. They were benefited by the fact that they pieced out a couple of portions of their business. So they generated higher than average operating cash flow and investing activity cash flow in the last quarter. So they paid down some debt. So that's what this company is going to be doing over the next year, probably 2 or 3 years, is continuing to whittle down the debt. And the core business over at this company certainly will allow them to do that. Now, let's move over to the technical segment. SOXX is still in a buying opportunity. It's actually been in a buying opportunity for probably about 3 weeks in a row. In fact, it's just kind of churning its way up this gold line. This is perfectly fine. Now, in the shorter term, you have kind of rolled over on this one. You're making a series of lower highs. Eventually, this breakneck trend will revert back, as we've talked about, to the longer term trend, which is down here closer to this purple line. So if you do want to buy into this one and you want to protect yourself to the downside, I would set this one up very, very tightly. You could buy in here at we'll call it 220 or so. You could have a stop loss, maybe $6 or $7 lower, with the idea that you come back up, maybe to retest the highs back up here at 240. That'd be $20 on upside. Maybe back to the middle of the channel, that would be back to 263, or a new higher high all the way back up here closer to about $280. So you could have $60 in upside, maybe $3, $4, $5 to the downside, maybe $10 to the downside. That would give you 5 to 6 to 1 risk to reward. That's exactly what you're looking for. 5 to 6 to 1 risk to reward. You honestly don't have to have a high batting average to be a successful investor at those percentages. The SMH, slightly different position. They're awaiting Broadcom earnings. If Broadcom earnings are very positive, this one will continue to move higher. If Broadcom breaks down, this one will move lower because Broadcom is a slightly higher weighting in that index. I took some lines off Nvidia because I had to take a screenshot of this chart for one of the articles that we published this week. Again, links down below to the newsletter. Make sure you are subscribed. But this one is still trailing up, and we can trade this red line for maybe kind of a gold line. This gold line is kind of a shorter term trend or intermediate term trend that's held for about a year and a half, 2 years. You've just confirmed a new higher high on this one. Nvidia actually could be bought at these levels because it looks like it wants to hold that level. AMD's longer term trend is this purple line. We have converged with it. There's multiple areas of support here at 136. I think somebody asked me if you would buy AMD. I could see buying AMD at these levels. Stop losses somewhere down into the 130, maybe just slightly lower than that, slightly higher than that, depending on how aggressive you want to be. And you want to break out from this wedge. We'll see this with ARM Holdings as well. You want to break to the upside on this one. You break to the upside, you're probably retesting the highs. Now, Broadcom reports their earnings on Thursday, December 12th. It is setting up almost identical to Apple, where it's made this multiple retest of these highs that you initially made back here in June. Good report, good guidance, should surge us probably significantly higher, maybe back up into the 200s. A breakdown's probably more exciting because you get a breakdown on this one. As long as things are not really, really bad fundamentally, it probably could set up some buying opportunities. Now, Intel, I actually thought about buying this one earlier when we were in this black channel. I think we even talked about it on last week's show. Now, if you're in this one, or if this happens to you and the CEO is fired, don't beat yourself up at all. There's no way to predict that the CEO is going to get fired, and not only the CEO get fired, but this be the reaction. So when something fundamentally happens, now if Intel did this on no news, then we have to kind of reevaluate our technical analysis and our technical abilities. But this was based all on fundamental news. And so if you made a technical trade that was then blown up by fundamental news, absolutely don't beat yourself up. But this is also reinforcing the importance of stop losses, either here just below the trend or these lows as well. You could have closed this one out and mitigated some losses. Now, this is starting to look like a value stock at some point. We'll continue to reassess this one. I think there's going to be an opportunity on this one. The most obvious is down here at about $19 per share. That's where the shares found footing after a dismal earnings report. We'll see if it retests that area. I honestly might step back into this one only because the company might get back on the rat track. I did not believe in Pat. I wanted Pat fired for several years. Now that he's out, maybe I get back into this one. Qualcomm is maybe a bidder of some of Intel's assets. They also could be a beneficiary if the company remains languishing and in turmoil and employees are unhappy. There's no executive leadership. Well, Qualcomm, along with AMD, could continue to benefit, but it's outside of a buying zone. TSM has just more recently confirmed a new higher high. They also benefit from Intel's foundry business basically being in flux. Although I never believed in their foundry business and TSM had nothing to worry about, this one's looking absolutely beautiful. I think you could make the argument that you're actually in that formation right now. And so you might not get a bigger dip on TSM because it's looking absolutely sensational. ASML is looking good. It's really found some footing down here at about 660 and it's found a bounce. Pullbacks on that one certainly can be bought, although it can be bought at that level as well. NXP is retesting an area that I bought it. So I bought it back in mid to late November. It popped. I sold a few shares. I'm still in this one. I think I'm either break even or maybe even slightly down on this one. But this is very easy because this is a long-term trend. This purple trend line, anytime you see a purple line, I try to keep these color codings consistent. Purple line is a long-term trend. You get back to a long-term trend, you should be buying, but it makes the trade very simple because a big break below long-term trend and I'm selling. I think my stop loss actually on this one is 211 because I'm assuming that we could probably come back here to the middle of the channel to 260. That would be $50 in upside and then potentially longer term, maybe a new higher high up at 300. I've got like a 10-to-1 risk reward on this one. So that's what's getting me excited about this one. If I'm wrong, I'll lose a little bit. If I'm right, I'll probably buy a new Rolex is probably what I'll buy. ARM Holdings. We don't get news on this one for a while, but this is an interesting setup. We've talked about this numerous times. We have confirmed basically a new series of lower lows. We'll try to tighten up this wedge that we've got going on. But again, you don't tune into the channel. These things will break higher or lower. I wish I could tell you which direction this would go into. In fact, I probably wouldn't even be making this video. I'd be liquidating all my assets if I knew if this one was going to break higher or lower. I don't, but it's going to break higher or lower on this one. They probably also, ARM probably benefits maybe less than AMD, less than Qualcomm, but they probably benefit again with Intel falling on its sword. Now, the stock that has Wall Street's attention is super micro. Fundamentals don't matter, but technicals still do a little bit. This one, I would say, is very close to breaking out of this downward channel. I think you would like to break above this cluster at 48, but this could, for some people, be close enough. But the fundamental danger of this one is so high. You have maybe the current or the auditor that was recently hired. What if they find something and they quit? I mean, if they quit, this thing basically goes down lower than we've probably seen. If they can't come up with their financials in February, also going lower. You also have to understand that there's going to be some companies that are going to be wary doing business with this company. Companies like DELL, which we'll talk about here in a second, could be picking up. I know we're mixing fundamentals and technicals with this one, but this one's so wacky for me. I work hard for my money. I don't want to play Russian roulette, which is basically what this is. I'll rather go to Vegas this January at CES. If you're in Vegas for CES, first week of January, second week of January, one of those, hit me up. Let's meet on the show floor if you're available. Now, DELL still looking good. It broke down, finding some footing here. A retest will change this to a gold line. A retest of this gold line could be a buying opportunity. Wouldn't blame anybody for stepping in here because you do potentially have like that type of formation starting with DELL. Micron's in the middle of the channel. You can buy it here if you want to. Lam Research, also middle of the channel. You can buy it if you want to. And Applied Materials has actually made its way below the middle of the channel. Continued weakness in Applied Materials. I do exactly what I do with NXP. With some of these stocks, I'll wait for a further pullback because you do get these kind of like glorious setups, these 10-to-1 setups where I'm either going to make $100 or I'm going to lose 10. That is what I wait for, folks. That was the Semiconductor Show for Sunday, December 8th. We'll join you again next week. We'll have Broadcom earnings. We'll see the reaction, not only in Broadcom, but some of the ETFs that have Broadcom as a heavyweight. We'll see the fallout through the rest of the industry, not just the semiconductor industry, but also the networking business as well. Will you have follow through with the rest of the semiconductors and maybe potential more news from Intel? Hopefully you guys enjoyed today's show. Don't forget to subscribe to the newsletter. Again, our pick last week went up 18%. You could have bagged an 18% gain in about 24 hours. Will hopefully continue that type of track record for you, both short-term and long-term type performance. Again, the newsletter is free right now. We're going to move to a paid model here very soon, probably in January. So you want to get in soon because I'll be offering a deal only to existing subscribers, those of you that have been loyal to me from the beginning. And again, don't worry if you can only afford free content or you can't afford to pay for stuff. There's always going to be free content for you, and I won't leave you behind. Hopefully you guys enjoyed today's video. See you again next week. Good luck with your investments.